Thanks for joining us today on Market Call. I'm Morella Fernandez. Ryan Modesto with us on the show, CEO and portfolio manager at I2I Capital Management. He'll take your questions on North American stocks. Here's how to reach us. 1-855-326-6266. You can email your questions as well. Market Call at bnnbloomberg.ca. Ryan, thanks for coming in.
Thanks for having me.
Let's talk about the markets. What do you see as positive trends working in the markets today?
Yeah. I think we're always so focused on the negatives in the markets and what can go wrong, the boogeymen out there, and we forget to think about the good things. So, maybe you could have more resolutions to wars. Maybe you could have continued or increased AI investment. Maybe you could have continued infrastructure investment in onshoring and reshoring trends. Or maybe even just have economic activity and economic boom from efficiencies caused from all these AI tools that are coming to market. Everybody's talking about the job loss side of things, but there really is a potential that you have increase in jobs or at least increase in productivity and margins for a lot of people. And maybe you just have good old-fashioned earnings growth, which is what we've had for the last 6 months or so, and it's one of the big drivers that's been taking markets to kind of where they're at right now as well.
Are there other sources of instability besides Iran that you're seeing?
There's always something to point to, some sort of risk. Certainly you have the ongoing war, or you have ongoing geopolitical risks globally. Geopolitical tensions have been rising in general. I think that's just kind of been the trend for the last 3 years or so, though. So markets have kind of gotten their arms around that and are able to deal with those risks, I think.
You say discernment is needed for the Canadian market when you're looking at investment. In what way?
Yeah, so if you look at the TSX, about 70% of the TSX consists of financials, energy, and commodities, which is fine. Last year that worked out really well for the TSX, but you have 3 sectors that make majority of the index, and they're kind of economically sensitive areas, or they're tied to the performance of commodities. Mm-hmm. So again, that can work well sometimes, but you could have a scenario where if commodities and energy markets go sideways for a year or two, which is not out of the realm of possibility, markets could kind of lag other markets as well. Markets on the TSX could lag other markets as well. Where
is your investment focus these days?
We like growth, so we focus on growth and momentum. You could be a consumer staple stock, but if you're growing, we'll look at it. We're really interested in the tech and the AI sectors right now. A lot of growth there, a lot of investment in those spaces as well.
So because you're so widely focused and just looking for growth, how do you narrow down where you're going to put money?
That's a good question. You have to, you start with kind of a wide net, but you kind of create a sandbox that you can focus on. So for us, it's things like strong balance sheets, good momentum, 52-week highs often puts a company to the top of our list, and just quality operating history for companies as well, and positive cash flows too. So that helps narrow down your universe a little bit, and you kind of it's just turning over as many rocks as possible over time and looking for the best companies you can find.
All right, let's take a quick break. We'll get to phone calls for Ryan Modesto, I2I Capital Management. Again, taking your questions on North American stocks. Here's how to reach us. Back in a moment. Welcome back to Market Call. Barry has written in. He says, can you give me your analysis on Atkins Realis? Do you own it? Is it a good entry point? Atkins Realis down at 84 today has been going kind of sideways for a little while before dropping. It has signed new contracts out in the UK, but is there something holding it back?
Yeah, so this is formerly SNC-Lavalin, and if you're familiar with the history of SNC-Lavalin, they got some contract issues. They've had execution issues in the past. So knowing the history, we're not huge fans of Atkins Realis, but they've been getting a lot of attention recently because of their nuclear business. So nuclear's kind of been the hot thing recently, and they have an engineering nuclear business that has been getting a lot of attention. The growth rate's okay at kind of mid-single-digit grower, and they're trading about 18 times forward earnings. So valuation-wise, it looks okay. But just knowing the history of the name and kind of where they've been, we think there's other names we would prefer in the Canadian engineering services space.
In the infrastructure build-out, everybody thought they would benefit, of course, from the Canadian plans, but you're not seeing, others will benefit as well, I guess.
Yeah. And this stuff always is really exciting when you hear that first news release of so much money flowing into a certain space, but it always takes time, especially when it's related to government money, as it should. They need to, check their boxes and all that kind of stuff, but it takes time for that money to actually get released and flow through.
Okay, let's get to our first caller then. JC on the line in Churchill, Manitoba. JC, go ahead.
Hi there. I'm calling about MDA Space. It's been on quite the run lately. I'm just wondering if there's potential for it to keep going.
Thank you for the question. MDA Space, of course, does a lot of work sort of in Canada. The U.S. are very well known for the Canadarm, I guess, but also for putting satellites in low orbit.
Yep.
And have you invested in them before?
Yeah, so we own some MDA for some of our clients. We really like this name, good space name. If you look on the U.S. side, a lot of the space names trade at very high valuations. They have high growth, they have high valuations, but they don't always have the greatest balance sheets. MDA kind of has it all. They're trading cheaper than a lot of the peers in the U.S. They have a good growth right now. The tailwinds are pretty clear of all the investments happening in space, and they're profitable. They have a good balance sheet to back it all up as well. So we really like this name. They have good momentum, and kind of they're sort of checking all the boxes right now. So it's kind of hitting some highs here, but we think it's a name to continue to look at. And also with all the SpaceX news coming on, kind of all the fervor around that, we think this name and other names in the space sector will continue to get attention.
So you'd hold it if you were in it now?
Yeah.
Okay. Yeah. Let's move on to Kevin in Toronto with this question. Kevin, go ahead.
Yeah, Morella, thanks for taking my call. I'd like to ask your guest about GFL. Is this a good entry point? Thank you.
Okay, thank you for the question. GFL, of course, is waste management. You see their trucks everywhere on the road. They're bright green. Do you invest in this space at all? What do you see as the growth?
We're not opposed. We don't own GFL. We're not opposed to waste management names in general. We like the business. It's stable, reliable type of revenue streams and earnings streams, and they can kind of, year to year increase their prices, maybe by inflation, maybe by a bit more, just because everyone needs to have their garbage picked up at the end of the day. GFL's been good with doing some acquisitions and getting some growth there. So it's a name we like. Again, we don't prefer negative momentum. So we think you can wait a bit, let it kind of settle in here, and maybe if it starts to turn upwards again, take a closer look at it. Good name overall, though. No issues with it. Just maybe not quite right now.
Okay. That was for Kevin. Let's go to the next caller, Henry in Toronto. Henry, go ahead.
What's your long-term view on Enbridge? Thank you.
Okay, very quick question there. Enbridge as a utilities play, pipeline services, that kind of thing. Obviously, much demand with the build-out in Canada.
Yeah, a lot of energy demand out there. We like it. This company's been around forever. They continue to execute. They continue to find ways to grow. Great capital allocator with their dividend. So there's not too much negative to say about this one. They're trading at, I think, about 22 or 26 times earnings. So, maybe a bit of an elevated valuation, but with the consistency and the reliability of their earnings and cash flow, we think that's quite reasonable. So we like this name and don't really have too much in the way of concern.
Do you see it as a growth stock? Because it's more it feels like it's more steady than growth.
Yeah.
And I'm wondering, is it something that you'd put money in as a growth stock, or do you invest it sort of to park your money and keep it safe?
Yeah, it can be a bit of it's been a growth stock because with all kind of the AI and the energy demands out there, people are kind of looking at names like this and saying, well, they're going to have increased demand and potentially increased margins just with all of the energy demand that's coming down the pipeline. So you can be a defensive stock like this, but you can also have spurts of growth or periods of where you get rewarded a bit more.
Just to dig in for a moment, would you then, as opposed to going to utilities, would you go more into energy for an AI play?
No, I prefer kind of utilities and some independent power producers and things like that. Energy's fine. It's not my cup of tea in general. It makes sense to have some energy, some oil names in a portfolio, certainly, but not a sector that I'm totally interested in overall.
Okay, let's take a quick break. Getting to more of your phone calls and your emails. For Ryan Modesto of I2I Capital Management, taking your questions on North American stocks. Here's a number to reach us. We're back in just a moment. Stay tuned. Welcome back to Market Call. We have another email. This one from Bob. What are your guest thoughts on Premium Brands holding PBH for a long-term hold? Is this more of a defensive move, Premium Brands? Have you ever owned something in the space?
Not too recently on Premium Brands, but it's a name we think it's quite interesting. There's a bit of a dislocation here. I think they're trading about 13 times forward earnings, and they're about to grow. They're looking at 20% growth for the next year or two here. Meanwhile, they're doing about $1 billion in non-core asset sales, so they're really going to kind of turn the balance sheet upside down in a good way. And they've been having some pressure recently because beef prices have been going higher, so that's weighed on margins, brought the shares down a bit. But it seems like they're turning a bit of a corner here. And at this valuation with the growth that they have, we think it's quite interesting. And it's a kind of a staples type of business, so there's going to be some underlying demand that's consistent there as well.
Can you tell me what has weighed on the stock to date and where you see that turnaround happening? Maybe more specific on what would drive that. They do processed foods, and we talk all the time about processed foods being more out of favor these days.
Yeah. I mean, a lot of it's been higher food prices, like higher commodity prices on the beef side, and that's really squeezing their margins. And these tend to be lower margin businesses to begin with. So even little slips in margin can kind of hurt these names a bit. But over time, you kind of start to lap those higher or those margin issues, and then they can kind of start to find cost efficiency and then adjust. And we think they're kind of at that stage.
And they've got a bit of a dividend as well.
Yes.
Okay. Let's go back to the phone lines. Debbie's on the line in Burnaby, BC. Debbie, go ahead.
Hi, good morning. I'm just wondering on your thoughts on PNG, that would be Kraken, if it's a good investment or for a long-term investment. I'll hang up and listen. Thank you very much.
Thank you. Kraken would be under defense, right? They do underwater defense systems, which I imagine there would be more interest in that right now.
Yes, yeah. So, I mean, big caveat, high risk name, volatile name. So just keep that in mind when you're looking at it. But we do like this name. We like kind of the long-term trajectory they're on. Governments across the world are all looking at drones and how they fit into their strategy. And we don't think there's a whole lot of capacity out there to meet probably what's going to be a lot of demand coming for all these different types of drones. So Kraken, we think, fits really nicely into that space. And they're a bit different from a lot of other drone manufacturers and input providers where they focus on the underwater side of things as well. They just did an acquisition of a company called Volvilia, and this really increases their capacity and it kind of diversifies their business out a little bit as well. So it kind of gives them a new bit of a new growth platform to grow from.
You mentioned not a lot of competition in that space, in the underwater part of it?
Certainly not on public markets. There's competition out there, but it's hard to find publicly traded companies that are kind of a maritime drone focus.
Okay, and they're a Canadian company based
Yes.
out east. Okay, let's go back to the line then. Jack is on the line in Montebello, Quebec. Jack, go ahead.
Yes, I'd like to get your guest's opinion on Cogeco. I've called about it a couple of times before and never got a very, straight answer. I think maybe it's being colored by being in the telecom space, which is not very good generally, and but its metrics are earnings and cash flow metrics are considerably better than TELUS and BCE. So I'll listen to your opinion.
Okay, thank you for the question. Yeah, telecoms have not been great over the past number of years. Do you have an opinion on Cogeco?
Yeah, the telecom space in Canada is tough, right? Because you have lower population growth right now because of a pullback in immigration. And you also just have generally lower economic growth. These companies have also kind of pushed price over the last couple of years. So there's just not a whole lot of, call it, inflation adjustments they can do going forward. So all of them have kind of been stuck in a bit of this problematic growth area. Cogeco is kind of included in it. You know, it's cheap. They pay a nice dividend. It's not. We don't think it's going to hurt a portfolio a whole lot. So we're kind of fine. We'd be fine to hold it, but we'd probably prefer a Rogers or even a Quebecor.
So if he does already hold it, would you just recommend he stay in it?
Yeah, and your correlations are going to be should be pretty high across the telco space in Canada, regardless.
We always remind people Bell Media is the parent company of the channel. For us, BCE is a parent company of Bell Media. Let's go to Frida on the line in Chilliwack, BC. She's got a question. Frida, go ahead.
Hello. I'd like to ask you about Shopify and what you think the projection is. Thank you very much.
Okay, thank you for the question. Talk about a volatile stock. Shopify tends to move a lot.
Yes. And this is a software company, and we all know everybody hates software right now because AI is going to do everything that software does, apparently. But actually, Shopify has been very innovative in quickly rolling out AI services into and overlaying AI services into their current offerings as well. And they're seeing some growth from that. And they're seeing increased traction from that as well. This is a high growth company, super competitive, and it's a name we just don't really worry about too much. With this drawdown that they've had, we think it actually is presenting a pretty decent buying opportunity for shares.
Are you interested in it as a growth stock?
Yes, we think it's ownable for sure.
Okay, so that was for Shopify, of course, a Canadian company as well. Let's go to Michael in Montreal. Michael, go ahead.
Yes, hi. Is it possible to have the guest's opinion on Uber? And can you comment about the news that came out today in regards to acquiring Delivery Hero? out of Europe? Thank you very much.
Thank you for the question. Let's talk about Uber. Obviously, very well-known brand, well-known name. Is there a lot of growth here for this company?
Yeah, well, I think that's why you're seeing them do things like this
These
acquisition
takeovers,
of Delivery Hero, because it really is kind of a scale type of market, and economies of scale. So the more market share they can get, the more they can kind of choose the prices they want to charge people that use Uber. And it's a kind of a platform business too, right? So if they have all of the supply, when you're calling an Uber or a delivery, a car of some sort, you kind of have to go to Uber because they're the only ones with the cabs or the drivers now, kind of thing. So the acquisition makes sense. It's kind of, I think, just another step forward in kind of their strategy of world domination for delivery and things like that. But it's a good name. The valuation looks pretty good as well. They've executed over the long term. Some of the self-driving technologies that they could kind of roll out could be interesting. I think a lot of remains to be seen on if they can, have self-driving cars deliver your food for you. I was going to ask you,
do you see a role for them in autonomous driving, whether it be for delivery or for their technology use?
Yeah, and sometimes people think it's a good thing for Uber because they can use it. Sometimes people think it's a risk because other companies like Tesla could
take it over,
have a fleet and just kind of cut out the middleman's call it. But again, they already have kind of all of the supply with all the drivers and the platform through the Uber app or whatever it is. So we think that's less likely to happen. So interesting name for sure. We don't own it, but don't have any qualms with it either.
Let's take a quick break. We're going to have a look at Ryan's past picks when we come back. That's coming up next. Welcome back to Market Call. We're going through past picks from Ryan from March 5th of this year, so a couple months ago. At the time, he chose Ouster, O-U-S-T, on the NASDAQ at 21.18 U.S. to 44.73 today, so 111% upside, 111% for total return. Yeah, you did okay with that one.
Yeah,
we were talking a little bit earlier about what this company does. Is it called a LiDAR sensor?
LiDAR sensor.
Yeah, and can you explain what that is?
Yeah, so it's kind of like a radar sensor, but different. And they also have digital sensors as well. But essentially, they're kind of becoming one of the prominent platforms that are going to help robots see and interact with their surroundings. And LiDAR sensors are one of the things, but they've rolled out a few new products and made an interesting acquisition somewhat recently as well. And markets, I think, are really starting to wake up to the fact that they're kind of trying to position themselves as that go-to, call it robotics vision platform. And we think that's kind of why it's done so well recently as well.
Is there competition in that space? Is it great?
A lot of the competition comes out of China, and the U.S. has recently rolled out some rules where they actually are limiting access for Chinese products, because obviously you don't want foreign countries to be able to look at everything around you that's attached to a robot, right? So Ouster is there's like one other company, but Ouster we think is the highest quality, highest growth company that's doing this.
Okay, considering the run-up it's had, even in the last number of months since you recommended it, would you put new money in today? Yeah,
we're still quite comfortable with it. When we talked about 3 months ago, it was actually in a 30-40% drawdown, which is something to keep in mind. These are volatile growthy stocks, right? And sometimes just a shift in narrative or a negative macro environment can take names like this down 20% or more. So it was kind of in a bit of a trough, and we thought it looked really attractive at that point. So now we would say it's kind of back to normal, and now they can get back to regular business kind of thing. They're growing 30% year over year, and they have a pretty reliable cadence, it looks like, to hit that growth as well.
Let's get to your next past pick from March of this year. Intuit on the NASDAQ, INTU. 466.79 at the time to 315.83, so 32% down on return, total return as well. This has been bitten by the software concerns, I take it?
Yes, yeah, it's getting lumped in that software bucket. They do QuickBooks, MailChimp, and TurboTax, and also Credit Karma. So we kind of view them as almost the infrastructure for small, medium-sized businesses. So everyone's worried about AI kind of taking over. We think they'll actually utilize AI to improve their products and services, and I don't think a whole lot of companies are going to outsource, say, their bookkeeping to AI tools at this stage. And we think Intuit is on the forefront enough that they will actually be the ones releasing new, better tools for businesses as well. So this stock is actually trading at a 20-year valuation trough, which we just don't think makes a whole lot of sense. And they're even trading pretty much on par with where they were in the 2008 financial crisis. So valuation, we don't think gets much more attractive than this. And yeah, it either looks good here or you think it's going to go out of business. And we don't think it's going to go out of business.
Do you feel that way about a lot of the software stocks where people have been too quick to take them down and you think they're going to bounce back based on what they do with AI in-house?
For sure. I think it's probably one of the ripest areas right now. Not necessarily, doesn't mean the time is necessarily now because everyone absolutely hates it. Nobody wants to own it. And that kind of is when you want to start to pick away and nibble at these companies. The problem is we don't know if it's going to take 3 months, 6 months, or a year and a half for kind of markets to kind of realize the value that a lot of these names have. But they look pretty much across the board, the software names look really attractive. And we think the space you're going to look back in 12 months, maybe 2 years, and look at these valuations that you're seeing now. People are going to say, oh, that was so obvious. Why didn't we all own
jump
these
on
names
it.
kind of thing.
But you have to have the stomach for the next couple of years.
Exactly. Yeah.
Okay. Let's get to your next past pick from March, which is Celsius, CELH on the NASDAQ at 43.69. Down to 29.67 US, so 32% downside here, return and total return as well. And they're a holding company, but remind me a bit more about what they hold, what they do.
Yeah, so this is an energy drink company. Celsius is their core brand, but they also purchased Alani Nu about a year ago at a quite attractive valuation. So this is a high growth energy drink company gaining market share. Monster Energy is their main kind of competitor, their main peer. And this company, Monster, trades at premium valuation, but also has a fraction of the growth. So flip that around. Celsius is growing far faster and trading far cheaper than their peer, and they're stealing market share as well. So we think it's an attractive company, and there's just a bit of it's kind of lumped into not a software bucket, but just a weird bucket right now where nobody wants to own it, and we think it's at 18 times forward earnings with really high growth. It looks very attractive.
So you're still optimistic about it?
Yes.
Okay. Let's leave it there. We'll take a quick break. Coming back to your phone calls for Ryan Modesto of I2I Capital Management. We're back in just a moment. Stay tuned. Welcome back. Ryan Modesto, our guest today. We have another email question for him from Doug. Doug says, I am overweight in oil and I'm thinking of selling TOUs, or tourmaline, and buying TVE, which would be Tamarack. What do you think? Pulling up both tourmaline and Tamarack in just a second. I know you said you don't have a focus on energy, but you do have some energy holdings. Can you differentiate between the two? Would you position yourself in one versus the other?
Yeah, so I mean, tourmaline's a bit more of an oily name. So if you're selling that one to reduce energy and adding TVE, might not be kind of achieving what you're hoping it to achieve. But regardless, tourmaline and Tamarack, we like both of these companies. Tourmaline has been a bit of a sideways name because they've been doing some investments in growth and capital investments right now, but they're kind of turning back to a bit of a shareholder return strategy. So we think they're going to come back in vogue soon enough. TVE has been on a tear recently, really great momentum, and it's doing quite well, but it still trades about 11 times forward earnings, and there's good growth there. So we like TVE as well. It's going to be a bit more volatile, especially with some of this Iran news, probably going to be a bit more volatile as well, but we like both names. Just
out of curiosity, and I don't know if you have had a look at this, where do you think oil is going to settle sort of after this is done? Have you looked at that?
We think it could come down to kind of maybe the 70s might be a kind of a good target, but it's going to take time. I think they're saying this, you need 30 days to clear the strait to begin with. So you're probably looking at 30 days before anything overly material happens. And who knows what happens in 30 days with the way things have been going in the last year or so.
Okay. Let's move on to the next caller, then Taylor in Uxbridge, Ontario, with a question. Taylor, go ahead.
Hi. About a month ago, I invested in Capital Power, and investment's sort of gone sideways. But given the demand for power for data centers, et cetera, to see that I might be a good time to increase, because I only took a small position, and I'm thinking of doubling my number of stocks. What do you think?
Okay, thank you for the question. We see where Capital Power is today. Where are we in the bigger picture as far as the demand for energy? Because we've talked about this for about a year now, and I'm just wondering if it's still a strong theme this year and next.
We do think so. It takes time to build these data centers and put them up, right? And there's still a shortage of computing power out there. So there's a need for more data centers. There's a need for more power as well. And CPX has done a good job kind of positioning themselves to take advantage of this, especially in Western Canada. They have a couple MOUs or deals signed to kind of help build out or help provide some power to some up-and-coming data center build-outs, which is great. Meanwhile, the valuation looks pretty good. They're growing at an above-average rate given their kind of historical rates, and they pay a bit of a nice dividend as well. So we like Capital Power.
Okay, let's move on to the next caller. Chad is in Saskatoon. Chad, go ahead.
Good afternoon, Marilla and Ryan. Ryan, my question in what appear to be excellent quarters, strong revenue growth, accelerating membership additions, improving profitability and diversification beyond lending, yet the stock continues to trade like the market doesn't care or doesn't believe the story. Could I have your take on this, please? Thank you.
I like the way he put it, because it's true. Sometimes you get all of the fundamentals there. You see what could happen. Others see what could happen, but other investors just don't seem to care.
Yeah.
He's talking about SoFi Technologies. He might have cut out at the point he mentioned that. But when you have a stock that's set up this way or business set up this way, what do?
You need to be patient. So you've done the work, you've done the research, you know why you own it, and you're confident in your thesis. Sometimes it just takes time to play out. I mean, Ouster, with the returns it's had, we've owned that one for I think over a year probably, and it was going sideways as well. So especially for these small mid-cap names particularly, sometimes it takes time. Now you have to be careful. You have to sort of continue to check back in on the thesis, make sure that you're not just ignoring that you're wrong in some case as well. So in the case of SoFi, though, it's a name we think there's just concern over the consumer, and so they do higher risk lending, buy now pay later type of services. And so with a bit of the slowdown, higher oil pinching the consumer potentially as well, these names have kind of traded down a bit sideways. So good growth here, decent valuation, higher risk just given the business that they're in. So you just got to keep that in mind innately. In a bad macro market, these names won't do too well. We like it. We would prefer a company we own that's in the similar space called Sezzle that we would actually prefer. And they have a bit of a subscription business alongside their lending business that kind of helps a bit with their stability and their revenue visibility. But in general, we think SoFi is fine as well.
And what is the ticker for the one you recommended?
SEZL.
SEZL.
Yeah.
Okay. Good to know. Let's go to the next caller. Bob is in Toronto. Bob, go ahead.
Yeah, hi, Marilla. Hi, Ryan. Ryan, I'm wondering if you can give me your thoughts on Couche-Tard. It's hasn't been doing very much over the last probably year and a half. And I'm wondering if you think I should sell it or just hold on to it and wait till it goes up again. Thank you.
Okay, thank you for the question. A lot of background for Couche-Tard when it tried to go after some of the 7-Elevens in Japan, then walked away after pursuing that for a while. And then, as a lot of people have noticed, it hasn't done that much since then. Is this a company that you've invested in before?
Yep, and we like this company. It's they have decent kind of long-term growth, good capital allocator. They've made good acquisitions over time. You can make an argument maybe they're becoming a bit of a victim of their own success because as they've grown, it's harder to do acquisitions that move the needle a whole lot.
And is that going to hold them back a bit?
We think as long as they kind of continue to stick to what's worked for them in the past, maybe it takes a bit longer for those acquisitions to build, but we think that it does build over time. So we think it'll work out well. The valuation looks fine here. Probably a bit of a stronger economy, North American economy in general, GDP-wise would probably help a bit, but we think it's a fine name to hold.
They also own the fuel at the gas stations, right? They could get a benefit or a big lift from energy prices?
Yeah, they kind of get a margin on it, though, so higher energy prices itself doesn't necessarily mean that they make more money. There's sort of other factors that play in there.
Got it. All right, let's take a quick break. Back with more of your phone calls and your emails in just a moment. Stay tuned. Welcome back. Melinda is on the line in Toronto with a question today. Melinda, go ahead.
Hi, good afternoon. May I please have your guest because professional opinion on the big Apple computers? And I think Apple will be the dominant leader in AI. Do you share the same sentiment, please? Thank you.
Okay, thank you for the question. So Apple doesn't really have its own AI offering. It's been borrowing from others. Yes. But do you think it'll benefit from AI in different ways?
So this is Apple in general. I mean, it's probably one of the best run companies ever, maybe. I don't think that's an aggressive thing to say, right? It's just a very well run company, one of the best to ever do it. Great growth, great margins over the years. I think the more recent knock you can have on them, though, is that they've kind of lacked in innovation. I mean, I can't remember what they're called now, but the Google goggles have been kind of a flop. The fact that no one really knows their name, I think, is maybe testament to that a little bit. And they've been certainly absent on the AI investment cycle currently. That might be part of their strategy. They might just be waiting to kind of have the dust settle, and maybe they'll go and just put a big wad of cash down and buy a company or build something out.
I was going to say the counter argument is there, let everybody else do the work and then buy it.
For sure. And something's happened. So recently there's been a CEO change, yes. Right? So, and this new CEO is more hardware focused. So it looks like they're kind of maybe positioning for, the next era of Apple maybe. And my guess would be that it's related to AI as well, because I think it's one of those, this is why all the other mega cap names are investing in it, because it could pose an existential issue to a lot of these large incumbent companies if they allow some other upstart come and kind of start taking market share in some different ways. So we like Apple, great company, certainly have no issues with having it in a portfolio. Our only knock on it, though, is just we would like to see kind of maybe a reinvigoration of their innovation.
Let's move on to an email from Garrett. He says, what are your top uranium stocks? We talked a little bit about Atkins Realis earlier in the nuclear space. Uranium had a big run up last year, sort of early in the year, with the energy, let me get into energy stocks and build out an energy infrastructure. Do you have a favorite play in this area?
The commodity space is tough because it's been so hot lately. So Cameco is kind of that one you go to. And there's not too many, call it established uranium names. But the issue with Cameco is that because it's kind of one of the few investable pure plays out there, it's very expensive. So it's a name where, if you really want exposure to uranium, Cameco could work, but it's really hard we think it's really hard to justify it at this valuation. Another name to consider, and I'm not very well up on this name, so just take it with a grain of salt, but a name to consider on the US side is a name called BWX Technologies. BWXT is the ticker. They kind of have a uranium engineering type of business as well. That could be a name to look into further.
If you're looking around. Okay, yeah. Let's get to the next email from Sunny. What does Ryan think about BlackBerry? Seems like it's on an upswing right now. And I'm holding some call options that strike at $350 mid next month. Wondering if I should sell now or hang on to it and own the shares when the calls expire. So BlackBerry reported earnings, did pretty well. It's tried to change itself around as to what space it's in, which is now security, essentially. Yeah. What do you think of the company? And I don't know if you can speak specifically to the question about its calls.
Yeah, I'll stay away from the options a bit.
Okay.
But the hats off to BlackBerry. They've been kind of down and out for a little bit, and it's been a long journey, but they're making moves to kind of turn things around. So certainly that's impressive, and I think management needs a bit of a nod of the changes that they've made. The automotive security software that they're moving into seems to be gaining traction, and earnings have been good. They've had a really good string of earnings beats over the last year, which we think is notable. It's had quite a run here, so we would just temper our expectations a little bit with it, and it's still kind of a mid-single to high single-digit grower at this stage, but the valuation has really expanded. So interesting name. We think it's one to watch, but just it's going to be volatile. We think you can kind of maybe take a step back a little bit and just let it trade and settle in a bit.
Okay. Let's get to the next email then from Mike. Mike says, may I have your guest opinion on Stantec? It has a $9 billion backlog, and most analysts rate it as a buy. Stantec, another one of the companies that could benefit from build out around the world and upgrade. Do you like Stantec?
We like Stantec, but I'm going to switch it a bit. We like WSP Global better. WSP is trading about 15 times forward earnings right now, which is pretty much at the low for their 10-year valuation. There's a bit of like an AI concern on these names that AI is going to eat into engineering services,
yes.
and we just don't think that makes a whole lot of sense. WSP has been around for years. They've been a great grower. They're growing in the double digits, and they just made an interesting acquisition of a company focused on power in the engineering space as well. And these companies typically get a premium valuation in the markets, and WSP is not getting any of that. And we think, given the tailwinds in power, we think it was a pretty smart acquisition that they did and should be kind of a new growth platform over the medium term for the company.
Okay, that's WSP Global. Let's get to the next email from Gurmeet. SpaceX going to be public as soon as June 12th. Should I buy same day or should I wait? And the question is, can you even get in on that, considering the interest? Give us your thoughts on SpaceX.
It's going to be a fun one to watch. Typically, we don't like buying into brand new IPOs just because it's so volatile, and especially if it's top of the headlines on a daily basis type
Everybody
of IPO.
wants a
It's
part of
that
it,
new
yes.
hot thing. I mean, it'll probably do. I shouldn't even say that. I don't know. Nobody really knows what it's going to do the day it comes out, but it's going to be volatile. The valuation is going to be quite high. So we would just sit on the sidelines, watch it. But maybe you could kind of look at some other space names that are out there, and because you're kind of getting a halo effect right now from SpaceX. Now everybody's kind of thinking about the space sector, so they're looking into what else there is out there, like MDA Space that we were talking about earlier, and those names are benefiting, and they'll probably most of them will or are trading at a lower valuation than what SpaceX will be trading at is also. So we think that maybe is kind of the approach to take.
So give a lift. Are there others besides MDA Space? That's the only one I can think of at the top of my head.
You have to go to the
in
US. Yeah.
Okay. All right, let's get to this email from Carlos. Canadian National Railway closed to its 52-week high. What's the reason for that, and what is your outlook for this stock and the North American rails? I'm always interested in the guest's opinion on the rails because trade has been what it has been for the past year since tariffs were announced. And rails, which have always been sort of that staple defensive buy for people, has turned sort of a little off. Yeah. And people are wondering what's next. And we still have CUSMA, which is being reviewed. So where do you land on rails?
Yeah, we think it's kind of a game of patience on these names, but there's going to be a stable, steady underlying demand for what these railways provide. They also are very good at buying back shares and increasing their dividends over the years. So we wouldn't be worried about it. We'd be fine owning it. For these things to really get moving, you're going to need an uptick in GDP growth in general, just to, you need a bit more economic activity on a broad base versus maybe, more AI focused and things like that. But, these companies have had their times where they traded sideways for over a year in the past, and they kind of continue to chug higher after that. So we wouldn't.
Would you wait until that CUSMA review is over before investing? Would you invest before that on the hope of a bump from that?
Yeah, I think you can kind of maybe, if you're really concerned about that kind of catalyst or not, you could sort of pick away at it, average into it over time. But I'm not too certain that's going to have a huge impact on these names.
Let's take a quick break then. Ryan has new top picks for us when we come back. Stay tuned. Join us tomorrow for Market Call. Mike Philbrick on the show with us. He is CEO of Resolve Asset Management. He'll take your questions on ETFs. That is tomorrow. And if you miss Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Let's get to new top picks from Ryan Modesto. We're going to start with Kratos Defense and Security Solutions, KTOS, on the NASDAQ. We talked about some of the defense stocks being pushed down as Iran tries to work its way out of that conflict. You would dip in at where it is today. It was at a high just at the start of the year.
Yeah. We think defense names in general have really traded down as kind of that resolution to war is becoming more and more certain or higher probability. So defense names have come down, and we think there's a lot of buying opportunities in the defense space right now. If you look kind of globally, almost all governments are looking at increasing their defense budgets. They're all probably looking at rearmament. A lot of them are looking at restocking their inventories. And we think a big conversation that everyone's going to be having around kind of their defense posture is how drones fit into that. And we think it's going to be a big part of that conversation. And so then you're going to have a whole lot of capital investment flowing into drones. And there's a lot of drone companies out there, but there's not a whole lot of capacity probably to meet all of the demand that might be coming down the pipeline. So we think the drone space is quite interesting. And Kratos is kind of one of the remaining, I'd say, like established pure play drone companies out there. And one of they're scaling out or ramping up production of one of their main drones right now, which is the Loyal Wingman, and it kind of flies next to high-value fighter jets and kind of helps protect them as well. So pretty interesting. And they're usually at the cutting edge of new R&D with the government as well. So a really interesting name. And the valuation has really come down. They're still expensive. They traded a premium certainly, but for what these types of names are, they're trading far lower than they have in the past.
And as a big company, you mentioned they can keep up with the demand.
Yes, yeah, and they have kind of the capital coming in to help support that as well.
That was your first pick. Let's get to your next, which is Talon Energy, TLN, on the NASDAQ. This is also sort of an AI play, but give me your idea behind it.
Yeah. So it's an independent power producer, and we think if you're someone who's maybe missed the AI trade, or just you're not comfortable with maybe some of the elevated valuations in AI, this is the name you can look at because they're trading about 14 times earnings, and they kind of have that derived demand play from AI and data centers because they're providing energy to those spaces. About 50% of going forward, 50% of the new capacity they build out is going to go towards data centers, and they're growing in the double digits currently as well. And these companies have consistent, reliable, and highly visible revenue and cash flow streams. And typically, when you're a company like that, you trade at a premium. You don't trade at a discount. And these companies are Talon, but other companies in the space as well are trading at quite attractive valuation multiples long term, we think.
Okay, so it's still a way for you to get into that energy demand these days. Let's get to your last pick then. Is it nVent Electric?
Yes.
And tell me a little bit about them.
So NVT is more of like a traditional provider of capital equipment to data center build out, but also industrial, kind of the onshoring and infrastructure trend in general as well. So this company is growing at a high rate. There's a lot of demand in this space and there's a lot of supply, but not enough supply to meet the demand. So these companies can also now charge higher margins and get better cash flows from that. That won't last forever, but trading at about 31 times forward earnings, given the growth that this company is seeing, we think it's pretty attractive, and it's trading at a lower valuation than many of their peers as well. They've been really good in the past of doing kind of unique acquisitions that help fill in some white space that they have across the data center. So there's a certain area that maybe they don't have exposure to. They go out and purchase that company, and now they can also sell into that space and then cross-sell and gain new customers and things like that. So they've done a really good job, and we view it as a bit more of an under-the-radar name from maybe more traditional AI capital equipment type of names.
I'm going to put you on the spot and ask you, what do you think your strongest play is in the AI space? What sector would you go with?
We like the data center space right now. There's a lot of interesting data center. Well, there's one interesting data center name. I might say that for a topic pick for another
like the
episode,
actual build out of the data center as opposed to the energy play, as opposed to the electrification.
Yeah. Okay. Yeah. Certainly the data centers are really interesting right now. They just consistently, when you read through their earnings, there is more demand than they can supply, and it's multiples more demand. And now they're increasing prices on almost a quarterly basis. So a lot of things are working well. At some point, there will be a bit of a peak in demand. We don't think it's anytime soon. So they're volatile names, ones to watch. But if you want kind of that leveraged exposure to AI, we think data centers are pretty interesting.
And
be careful.
Investors are going to think, I've already missed the boat on this, so I'm going to sit back. Should you be sitting back?
We don't think so. No, we think it's a long-term trend. There's a lot of work to be done still to even get to a balanced supply-demand dynamic.
So we're talking a couple of years before that demand subsides.
Yeah, we take it year by year, every quarter by quarter, honestly. But every year, you think you kind of sharpen the pencil, see how things look, what the mega caps are doing in terms of their investment in the space, and then you kind of reassess. But yeah, we think certainly you have a 12-month runway, we think.
All right. Brian Modesto, thanks for joining us. Appreciate you coming in.
Thanks for having me.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.